Really, the big focus of the day is some of those disappointing retail numbers.
Right. Well, there's a lot of focus today on a multitude of things. So it's taking some of the shine out of the market in terms of the blue chip stocks. The consumer is one of the things that started the day. One of the focus on Wall Street. Retail sales rising 0.4% in April from the previous month. That's according to the Commerce Department, but that was weaker than expected. The report coming on the heels of disappointing results and guidance from Home Depot. Joining us now to discuss is Jim Smigiel, SEI Chief Investment Officer. So let's get right into this data that we had on the consumer. What does it say to you, or what should it signal about market sentiment, Jim?
Sure. Hi, Diane. Thanks for having me. I mean, it's just another canary in the coal mine, if you will. The market is really trying to gauge what are the probabilities of recession. How close are we to recession this year, given the massive Fed action over the last 18 months or so? And the consumer has really been a bright spot for a long period of time. Flush with cash. Is that kind of running out? Is that kind of catalyst for propping up kind of the economic activity here? Has that reached its peak, and are we facing tougher times ahead?
Yeah, and to that point, we did hear from Home Depot today, Jim, sort of saying that consumers are starting to delay some of their projects. Discretionary spending is starting to pull back. If the current quarter, or the results that we just saw from the last quarter, if that's not necessarily sort of a warning sign, what are we likely to see moving forward here because of the outlook that was given by the company?
Yeah, I think it's one of many. I mean, if we want to take a step back and kind of look at the macro picture here, this is really that kind of bottom up viewpoint of the individual consumer slowing things down. We've had three to four bank failures. We've had a systematically important bank in Europe go under. There's a lot of things that we're kind of adding to the list here that are giving investors this pause and this warning, and whether or not the Fed is done hiking or not done hiking. The market is still expecting cuts in 2023, which we think is a little perhaps off the beaten path of actual reality, given what Fed talking heads have been saying. So again, this is just the consumer part of this is just yet another thing to add to the list, that wall of worry, if you will, that we're headed for tougher economic times.
I like that term, wallet wary. All right, let's switch gears a little bit and talk about this debt ceiling, the debt dilemma around it. There's a lot of political brinksmanship just happening, and we've been here before, Jim. I mean, you go back to 2011, and it just comes down to the wire. What's your expectations with regard to what we're facing now? Do you expect a resolution?
We do expect a resolution, and and I say that with a bit of hesitancy, because you're right. We have been here before. We've always made it out of this kind of political theater. Although there are some things about this time around that appear to be a bit different, and there are other things that actually are a bit of a silver lining. So we have a budget. That's a positive. That's actually a bit ahead of schedule. We can look at that and say, okay, well, now at least we have two sides that can negotiate from the positions that they have actually put on the table. The other thing, and this gets a little political, but I think it is worth noting, the popularity of the president is not in a good place. It has been falling. It's been falling relatively recently as well. Everyone is motivated to get something done here. Everyone is motivated to save a bit of face. So I think that the common view of the debt ceiling debacle that we go through every few years or so is that there's going to be volatility. We're going to wait up until the last moment, and we're going to get something done. I have to say we're kind of consensus on this. I think we do get things done. I think we do wait as long as humanly possible. But there's just no benefit for anyone involved in these negotiations to have one of the several bad outcomes come to fruition here.
But so President Biden has a trip coming up. So do you foresee this being one of those instances where they're just going to kick the can down the road to September, for instance?
100%. I mean, essentially, the entire debt ceiling itself is one long exercise in kicking the can down the road. I mean, the debt ceiling historically has done nothing, because all the debt ceiling does is get raised time after time after time. And there's, the underlying issue here are the untouchables, right? There are the entitlement programs. If we really need to get a hold of government debt, which of course we do, If those are the third rail and we can't touch those and discuss reform in commonsensical ways that everyone can agree on, like raising the age or means testing or things along those lines, then honestly, we aren't really serious about solving the issue of government debt. So yes, this is just going to be another exercise of kicking the can down the road.
So, Jim, the expectation may be that we're not necessarily going to default on our debt, but you've had a number of executives, especially from the banking sector, have come out and said just to get up to that X date is concern enough that that could already hurt the credibility. If you look at the market reaction, there seems to be an expectation that things are going to be fine in the end. Is there a bit of complacency?
There is a bit of complacency, but I will say in some areas, I mean, we do see differences in the yields of short-term treasuries, prior to the X date or what we assume to be the X date and those yields after the X date. Again, we've been down this road before. We're kind of conditioned to how this usually plays out, which is lots and lots of volatility right up until a resolution. But to your underlying point, absolutely, this is not helpful to anyone. To market participants, to investors, to politicians. There's really no one benefiting from this because this has yet to actually spur real reform in terms of government spending and being able to actually stay within our means. So yeah, I just don't see any upside whatsoever at all. And playing chicken with short-term yield and having to rely on kind of government accounting of being able to move things around to pay our bills. There's really no one that's benefiting from this. All this is adding is risk and volatility. And we just don't see any kind of meaningful outcome here other than let's just extend the date.
All right, Jim, let's switch gears a little bit and talk about the Fed. So their next meeting in June. At their last meeting, of course, they raised rates. Now, we've got some Fed speak out today. Cleveland Fed President Loretta Mester saying this, quote, when we get the policy to that rate, I think we're going to be holding for a while in order to make sure that the interest rate is coming back down. So I don't put it in terms of a pause. I put it in terms of a hold, end quote. And so let's just talk about that with the perspective of there had been some chatter around expectations for a Fed pause, possibly at the next meeting in June. I think that chatter has kind of died down a little bit given some of the recent economic data that we've seen. What are your expectations for the Fed throughout the rest of the year?
I mean, this is a really key point for investors to understand, and this has kind of been going on for a while now. It's been this debate over do we get a pause or do we actually get a pivot to rate cuts. I think the recent talking heads outside of the one that you just mentioned have been a little bit more hawkish. They've been looking at this as being very, very data dependent, meaning depending on what we see coming in between now and the next meeting, which is not that far away, this could be a live meeting and we could see another 25 basis point hike. From our perspective, we don't think that's the case. We do think they skip a meeting. They did a lot of work in a very, very short period of time. Your graph that was on previously is a great graph. That is a vertical line going straight up in a 12-month to 18-month time frame. They did quite a bit of work, kind of unprecedented in the number of hikes in the short period of time. It is definitely worth their while to take a step back. There is a lag. We know there's a lag to monetary policy, and just to see how this plays out over time. They have a difficult situation that they're in. We have the lowest unemployment since 1969. We still have core inflation that has a 5 handle on it. This is not the time that they're going to immediately just kind of pause and announce to investors that they're completely done. They're going to be data dependent because their two mandates, price stability and full employment, they are at extremes even today.
So that points to more uncertainty. In that environment, where do you put your money?
We put our money kind of against what the market is pricing in, which is, again, a quicker reversal in 2023 with roughly two rate cuts priced in. We don't see that happening. And this kind of gets back to another bit of an issue is that I think we talked about being used to what happens at the debt ceiling. I think market participants are also used to what happens when the market gets in trouble, when the economy gets in trouble, and that the Fed cuts, that reaction function that the Fed typically has. That's going to be difficult to react the same way that they've done in the past with low levels of employment, with still elevated levels of inflation. My point being, I think the Fed is willing to experience a bit more economic and market pain than maybe what we've been used to in the past before they adjust monetary policy to make sure that this inflation issue is settled.
All right, well, we're going to have to put a bookmark into our conversation. Love having you on as per usual. Jim Smigiel, thank you so much for the time today.